Binance is blurring the line between crypto trading and Wall Street once again, but this time, it's not with another altcoin. The exchange has confirmed plans to launch 3 new TradFi perpetuals, synthetic derivatives that mirror the price of traditional financial assets without requiring ownership of the underlying stocks or commodities. This isn't just an expansion of Binance Futures' product suite. It's a strategic move to pull TradFi traders deeper into the crypto ecosystem, using familiar instruments wrapped in crypto-native mechanics. The contracts will be USDS-margined, meaning all settlements happen in stablecoin, and traders won't ever hold the real-world asset. That changes who can access these markets and how quickly they can react to macro movements, all from within a single platform. The announcement came through an official Binance support channel, not a marketing blast, signaling this is a structural upgrade, not just a feature drop. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The real innovation isn't just the asset class, it's the delivery mechanism. TradFi perpetuals operate on the same index pricing model used for stock perpetuals on Binance Academy's guides, meaning each contract tracks a real-time reference price from the underlying market. This keeps the synthetic exposure accurate without expiration dates. Instead of settling at maturity, these contracts use funding rates to stay anchored, a mechanism familiar to crypto traders but now applied to non-crypto assets. Here's how it works. The price of each perpetual is tied to an external index, likely sourced from regulated exchanges or data providers. If the perpetual trades above that index, longs pay shorts through periodic funding payments. If it trades below, the flow reverses. This creates a self-correcting system where arbitrage incentives keep the contract in line with the real-world asset. For traders, that means they can gain exposure to traditional markets without dealing with brokerage accounts, custody, or settlement delays. But the risk remains. Liquidation mechanics are identical to crypto perpetuals. If margin levels drop below maintenance thresholds, positions are closed automatically. There's no bailout, no extension, just the math of leverage. And because these are USDS-margined contracts, volatility in the stablecoin or the underlying asset can amplify liquidation risk, especially during news-driven spikes. The important part is not just that Binance is listing new contracts, but what this reveals about market evolution. The rise of synthetic TradFi exposure is happening alongside other convergence signals, like Grayscale and Van Eck updating their BNB ETF filings. These are not isolated events. They're pieces of a larger shift. Institutional-grade financial products are being rebuilt on crypto rails. Still, uncertainty remains. Launch timing is unconfirmed, and without knowing initial leverage parameters or market maker commitments, it's hard to predict how these contracts will perform at go-live. The real test will come in the first 24 hours. Traders should watch for tight opening spreads, evidence of strong market maker support, and early open interest growth, which signals organic demand. But the most telling signal will be funding rate behavior. If rates swing sharply positive or negative, it means positioning is lopsided, creating a tinderbox for rapid liquidations. A balanced rate, on the other hand, suggests the market is absorbing the product evenly. Liquidity depth will ultimately determine whether these TradFi perpetuals become mainstream tools or remain niche experiments. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next signal to watch is Binance's official announcements channel. That's where launch dates and contract specs will drop. When they do, the market will respond, not just in trading volume, but in how quickly other exchanges follow. The deeper story here isn't about Binance alone. It's about the accelerating fusion of crypto traditional finance convergence. And for traders watching the space, the question is whether this model will spread. It's whether they're ready for the volatility that comes with it.